What a week. Besides the pullback that we got back down to the 22, the lift, CPI, I think the best thing for us to do is to understand that there's a 34,000 foot view out there that we have to pay attention to and then drill into the minutia. But if we don't look at the 34,000 view and say what is really going on out there and how it compared to other times, I think it's going to be a huge mistake. There are a couple things here that I think are worth pointing out that I've been talking and yammering on for some time because I do think it's super important. If we take a look at the S&P right here on the 50, you neutraled out and you held. If we go and take a look at this in regards to the ES, which is the futures market, we can see that we came right back down to that CPI level and we held, and right to where we got good afternoon and it stopped. I thought that's where we were going. That's not where we went, and we're back over the neutral line. So this is how I see the oversold that just took place. What we're going to do now is we're going to walk through everything that I see from 34,000 feet up and drill into it. And I think that this is going to be pretty enlightening to what is really going on out there, and then how this uncertainty, what we have between administrations and globally, is creating massive opportunity that people aren't even looking at. As always, subscribe to the channel, click all notifications. If you are trying to get into the community and you are on the wait list, please check your email over the next 5 days, because then it's going to be open and then closed enrollment again for a period of time. That's it. Let's go. So when we can't see the forest through the trees, the best thing that I know to do is to zoom out. When in doubt, zoom out, look for other periods of time that may have looked similar, and then go forward from there. The best thing about past performance is you can use that to look at what happens in the future. Is it perfect? No, nothing ever is, but it's the best that we have. So the one thing that really stood out to me when we go through everything was, if we take a look at 1995, we had an increase in here in productivity based upon everybody getting a website. And then as they all got their websites, the most important thing about this was Greenspan was cutting rates right into this. And as he was cutting rates, we had increased productivity based upon a new technology. Now, for those that weren't trading back here, back in the day, you weren't really aware of this, nor did you really care about it to learn it. But this led to a massive, massive rally. And then, of course, that rally peaks, and then we have our crash and burn, and then go from there. So what we look for is during periods of times like this where we have similarities, and we have a lot of similarities to here. There's also a lot that's different. Back here, they couldn't afford the technology that they were buying, meaning the companies that were growing, they could not afford the technology. So they would do secondaries, convertibles, anything that would get capital. We don't have that right now. Right now, we have these companies with huge amounts of cash flow that are just using their cash to buy it. And that's going to go on for as long without a return as possible until investors are saying, hey, you're spending tens of billions of dollars. We're not seeing a return on this. That's going to be a fundamental click. That's going to be a problem. But from a technical standpoint, if you go back and say, well, this is when Greenspan started cutting rates, and it was right in here, and then all of a sudden we just kept going. This was when Russia came out and defaulted on their debt. And then as we pushed higher and higher, it just became very clear that this was just not sustainable. And we can see that the RSI back here was giving us clear indications of this, like something is wrong. Every rally, you were actually not only hitting a lower low, but you were hitting lower lows in comparison to those as you were hitting higher highs, and you finally cracked. Interestingly enough, the biggest cracks that always happen, this is a weekly S&P chart, the biggest cracks that always happen, you're always under that neutral line. So you always want to watch under that neutral line, but we're looking at the weekly to see if we can garner anything from this. And there's some things here that are pretty darn clear that we're going to get into in a second. But if we take a look at this and go through time, you can see 2022, how we held that level. What always gives us bottoms? And I want to view from 34,000 feet, meaning I want to look out in years versus days, because sometimes when we're doing these day trades or swing trades, people tend to forget that the majority of money is made in catching thematic moves. It's not in catching that 2 or 3 points here and there. It's understanding what's really going on and then just grabbing the tiger by its tail and going for a ride. So if we look at these RSIs again, and we just kind of see what's going on here, and we can see that divergence here very, very clearly, which marked the bottom of 2023. And then if we go through this again, we can see our negative divergence up here, and that negative divergence as it got lower and lower was really the top once again, as we can see that negative divergence here. And then what really marked that bottom? And these are not bottoms that are hanging around for a very short period of time. They are real bottoms. They are bottoms that have lasted for years, not for weeks or months, but for years. And so it's always important to take a look at this and understand it so that when we see it again, it's definitely something that we can put into our system. Let's get rid of this little line right there. And let's just take a look at that again. And here's 2011. And you're going to say, well, what does this have to do with today? Well, I think it has a lot to do with today as we go through time, and we just mark these off so you guys can see them. But it has a lot to do with today because we had this happen in 2022. And I remember I put out this tweet, which I won't bore you with showing again for those that have watched these videos. But I said, no one's going to ring a bell. And the whole purpose of this is when everybody is really, really fearful and it's the end of the world, well, that's when everybody starts to really realize that everyone's pretty much puked everything out that's left. And you saw that in 16, and then we rallied up. Interestingly enough, this is coming into an election year or out of an election year from 16 to 20. And then we can kind of see what happens there. And then, of course, we have our little battles, and it's crazy what the pandemic tends to look like on a weekly chart after time, isn't it? Really is, puts it in perspective. So when we look at something like this, and we start seeing these slopes over and over again, and then we work those slopes off, and then we bounce from that when we got all our freedom, liberation, and winning, we could see how that played out. But really, the amount of money, I'll just put a side note in here, the amount of money that the country is taking in, the U.S. is taking in here, is pretty staggering. I don't think people understand that they've taken in about $260 billion in tax revenue in about 90 days. And that might be actually a problem if the Supreme Court overturns it. And that could be something that we have to deal with. But what we're seeing here by looking at these levels is these do mark lows and they stay in place for years. Now, have we gone through this one? Has this one played out? Well, if we take a look from 15 over, this one was about 5 years long. If we look at these, we never really came back from them. From 09, they stayed in place, and all we had to do was wait for the next to start laying in lumber again, or moving capital in. And I think that this is really important for us to get. So we're over. So clearly we're over. So that means that this is going to happen. Well, that's not necessarily the case. You can stay above for a very long period of time before you even get double taps. For example, if we look at some of these double or triple taps before this starts to forecast itself, and the real forecast is in these drops below the 70 line. The real forecast is these drops below the 70 line, over the 70, under the 70. You'll note that those over the 70, under the 70 lines are really what will mark a top. These, not so much. And there's a reason for that. I did an RSI video on this a long time ago, and we'll do another one eventually that'll be a little more up to date. Not up to date in that the data has changed, but up to date in the fact that I now know how to use a screen sharing implement and cursors. The first videos I ever did were pretty rough. Actually, it's funny because I'm going to go over some Ichimoku cloud stuff today, and that was the first video I ever did. And it's pretty rough, but it's interesting because that's like the most watched video I have. And a lot of people, watch that and they always have their comments, but it's kind of funny. Anyway, if we take a look at how we're moving here, we're breaking out. All right, so what do we take from this? Yes, we're over, but are we over like we are over here? And then we're going to keep moving forward for years? I think there's an argument to be made for that. We can all talk about it's expensive, it's this or that, but we have to understand why we came in on areas. Like, why did we drop here? And then why did we drop any of these other times? For example, .com is constantly being thrown at us here. So does the market exhibit any signs of .com right now on a technical basis? We can have the overlay of the fundamental side, but quite frankly, the fundamental argument here is lost. What will happen here and what will get us in is the overexpending of CapEx that doesn't yield results. If they keep spending and they're not making money, you will have pension funds and large institutions that will come out and say things like, hey, you either need to make a return or we want the cash back. And if they want the cash back, they're going to get it or they're going to blow out of their stock, and no one's going to want that. That's how this ends. Now, whether that ends in 3 years, 5 years, 10 years, good luck. Because if they keep getting a return on investment like Microsoft's getting, Meta's getting, Google's getting, they're all getting a return on this investment so far, and they expect it to be more, well, no one's going to drop out of that race. So it's very different, in my opinion, than what you're seeing in here. Now, where does this lead us? Well, it leads us to understand that we have a fundamental catalyst that will come someday, but when that does, we don't know. But from a technical standpoint, what are we really dealing with? Now, in front of us is the S&P, and what I did was I divided it by the 10-year bond. And so I put the equation up here, and this is done by price, not done by yield. What are we really dealing with, and what are the signs that we would have to look? Well, when the S&P starts underperforming, meaning when people start wanting to buy bonds versus buying the index, and you can see how we started getting a little toppy in here in January, and then that top actually marks perfectly, and then people all of a sudden have no interest, right, in the S&P, and they're putting that money from January on over. So this led, and then by March, we saw it. So we got that lower low in here, that higher low. So in other words, you have a high here, and then this one is lower than that high. So we have the lower high. As we go forward, we can see the retest in here in August, and we can see the drop. And if we were to mark something like this off, we would just say this is the base, and this would be the technical breakdown of that base. And I've just put a private cloud that's also charts volatility in here, so you can see when the cloud flips from yellow to green. So you can start seeing it kind of tear up in here. And if we just go through time, you'll see that this tends to mark highs pretty clearly. And we can see up in here as well when you're breaking and you're rolling over. And what I really like about this from a long-term perspective is it tends to give a precursor ahead of time. And if you think about it, it makes sense, because if people are smart, and institutional investors, believe it or not, are smart, they're going to start buying bonds before retail does. So understanding this correlation between what the SPX is doing in regards to the bond yields gives you some indication here, and it will tend to mark bottoms pretty clearly as well. You can see your cloud flips in these little areas. And I'm not going to spend an inordinate amount of time on it, but when we mark off these levels, you'll even see it breaking out and setting up to break out ahead of when the S&P is going to break out. And I find great value in that. I think there is great value in that. But if we're looking at it from a long-term perspective, and let's get back into the daily, do you see any signs that even come close to exhibiting what we went through on any of these pullbacks? So even if we take a look in this 21 pullback, we can see it pretty clearly in here where we've hit the high in Jan, and then that was it. You couldn't get through it, and then as you're watching it, that's pretty much game over. Or you can see the turn in it right in here in June. Are you even seeing anything here that is remotely close to that? Well, and here, of course, when the cloud flipped back in February, and we can see that pretty clearly right here where that goes from, green is go, yellow is caution. And what happens when it flips right back in here? Well, most people are looking at this and saying, oh, geez, well, I missed the move. No, this is telling you that you're there. And what this cloud does is it's because people say, oh, it's an EMA. No, it's also tied, just so you get it, it's also tied to volatility and rate of change. So most of the indicators that I personally create, I tie them to what the rate of change is, and also to what the VIX is at, or the volatility over 30 days, because I find that gives more of a truer reading. So when you're looking at these and you're trying to compare it to other things, that's why it doesn't always line up the same way. But what am I getting at here? You flipped. Since you flipped, are you seeing any signs of any kind of interest, or any kind of interest here that they want to buy bonds over the S&P? And the answer is no. Now, there's other things out there that they do want to buy, and I think that there's good reason for that. For example, gold to me, or even silver, or any of the metals right now, to me, is an absolute no-brainer. And even at these levels, when we broke out of here, if you've been following these videos for some time, I did put this out and say, hey, this is pretty clear that you have just a straight out breakout. And why? Well, you have so much uncertainty between stagflation, inflation, the labor market. You have a lot of instability globally between the wars that are going on, the countries, the way that things are being run, that people start just saying, you know what, I want to own gold. I want to buy gold, and I want to own gold. And it's not just a US thing, but you're seeing instability, obviously, in the UK. You're seeing instability throughout the Middle East, and we're seeing instability in China. Nothing is going like, oh, wow, this is just so great right now. Like, we're just swimming in peace. Like, nobody feels that way when they look at their environment. There's a tremendous amount of uncertainty, whether that's because technology is moving so fast or geopolitical events. It doesn't really matter. And you also have a lot of central banks now that are buying gold. I don't see anything that is going to make that change. And you have a lot of power right now that is just being disrupted. And when that tends to happen, you have uncertainty. The more massive the uncertainty you have, the more people are going to buy gold and precious metals. And that's always going to lead to, some type of devaluation of that currency or drop in that currency. And so to boost that, they go out there and increase their gold reserves. China's been doing it. Russia's been doing it. There's no signs that this is going to stop. And actually, it's pretty interesting because it's rotating. If we took a look at this, to go off on a side note, if we just take a look, little side quest here for a second, and we take a look at Bitcoin divided by gold. Well, what's going on here? Well, I understand that, the kids today, they love their Bitcoin. But if you take a look at this from what you're saying, if you go back to when the election, and I just found this absolutely fascinating, so I just want to go on a little side quest here right now. But if you take a look at when we had the election, Bitcoin versus gold, well, you got your pop because everyone was like, yay, crypto. But what did they really do? Well, they really have been buying gold. If you take a look at it, yeah, they bought Bitcoin, but over gold, not so much. And I think that that's really a very important distinction. As a matter of fact, if you did the simplest thing and just took your peak from here and you looked at it, you keep trying to hold that peak, but you just broke that again. So what is this telling you? Well, this is telling you that you might want to take a look at gold more than you want to look at Bitcoin, right? So at least that's what the countries are going to do. They're not going to go out there and say, wow, I really need a wallet. And I think this is important. And I think that Bitcoin has some other issues. And I think Ethereum has some other issues out there, which hopefully we'll address in this video. But I do think that you have to understand that just because you're watching the market go up, people will look at some of these relationships and say S&P to gold, and based upon what we're seeing here, therefore we should roll over. I'm not really feeling that way because I think it's the instability that's doing it. Now, you can make the argument that the instability is going to drive the price of the S&P down because of the instability in the price earnings multiple. And that's a valid argument. The issue with that is that earnings have been through the roof. So you're not growing on multiple expansion. Partially, I think it's like 55% is earnings growth, 45% is multiple expansion. So you can make that argument like, well, wait a minute, why are we trading at 22 times, which is pretty rich, if we have this expansion, and we have this instability? It's a valid argument. The issue is that earnings keep going up and up and up. And as long as earnings keep going up through periods of increased productivity, and you're cutting the cost to borrow, which is what dropping interest rates do, well, then you're going to be in an environment where the market's going to go higher. And until that changes, and we'll look at some of those technicals. But gold, to me, is really that outlier. And what this is really telling me is that we have more instability, and that instability is going to lead to people continuing to buy gold. But we're not seeing those kinds of cracks. And I'll give you some more examples historically of what this looks like. And why this is important, because when we have these pullbacks, which we're about to explain, and then what I'm going to be looking for next week, it's really important to get the 34,000 foot view and then understand that sometimes, when you're in the forest, you can't see all the trees, right? You can't see it for what it is. And I see this a lot, especially in the community, where people are like, oh, we're definitely going to crash, or we're going to do this. We're going to have pullbacks. Of course we're going to have pullbacks. You don't have a backstop anymore. Daddy Warbucks is not out there buying everything anymore, right? The Fed $1.7 trillion backstop is gone. So yeah, you're going to have volatility. But I think the instability and the fact that these wars aren't ending, as a matter of fact, we could even argue that they're escalating. I also think that that is leading towards people wanting to own gold. And I don't see how this changes anytime soon unless we start swimming in peace. Now, in front of us is 5 years of technology versus energy. And I like leaving these up here so that you guys can do it for yourself. But what we'll see is if inflation starts kicking in, you'll start to see tech drop. And you'll start seeing energy outperform. For those that were in the community during this time, it's actually really where we just started the community. But we did exceptionally well on energy names. We did exceptionally well with oil royalty trust because we understood what this meant when inflation was going to kick up the way that it did. And it did. And it was a really great trade. But what does this mean for us now? Well, if we look over in this section, you'll start seeing that November really was the peak of tech versus energy. And then that's 2020. Try to rally, fails, comes back down in March, tries to push again into August. And it's telling you that you're having a problem in here. And it's telling you that problem exists way before you have any kind of issue with the S&P. Now, for point of reference, here above us is the S&P and below us is XLK divided by XLE. So tech divided by energy. And we'll see this peak here and you'll say, well, if I acted on that peak, I missed that. No one's telling you that you have to act, but what people are telling you is be aware. So when you see something like this, you want to say to yourself, okay, well, this is telling me that, hey, there might be some kind of issues out here or inflation is rearing its ugly head. Now, we know that we had one of the greatest inflation bubbles that we've ever had in all time. So it's very hard, and there's a reason why they say don't fight the Fed. Now, from November 20 on all the way to 21, which you'll note it took a year to work this out, we just had Powell out there buying mortgages, buying ETFs, buying bonds. You really can't fight trillions of dollars coming into the market to, quote, stabilize it. And what it did was increase like inflation and inflate assets to the point where people created new asset classes like NFTs, right, which are really just JPEGs. So what we're seeing there is you can't fight it. In other words, even when you see this, you have to understand the underlying reason behind it, which is why I always talk about the stool, the macro, the fundamental, and the technical. And that's really important to get. But look how tight this was in here versus what you're dealing with now. Well, what's the difference? You don't have the backstop. The backstop's going to lead to increased in volatility, which is actually good if you're a trader. But once he said, hey, I'm going to stop giving you your allowance and you're going to have to go out on your own and fend for yourself, well, that was the end of it. And that marked it. And this made it very clear that this was going to be a problem. But then you realize that inflation is the real issue here. Not they hit it and they actually created the inflation bubble. And then I don't think history is going to be very good to him. But they created this inflationary bubble. And now this is where we're at. Okay, so what does this tell us going forward? Well, what we need for it to stop, meaning we need for inflation to stop. And that's usually when we bottom. Now, this tied in perfectly with that RSI that I showed you earlier, but this is exactly what happened in June. Consumer prices, 9.1% over the year. It was the largest increase in 40 years. And again, really important to get what these bottoms are telling us. And then if we look here in October, consumer price index rose 0.4, adjusted basis increase September. Over the last 12 months, index increased 7.7% before seasonal adjustments. So what happened in here? Well, we had a decrease in CPI even after that peak. Well, that decrease in CPI said inflation is stopping. And once we saw that, that led to that environment. Now, this is what happened recently. And we have an increase 0.4% seasonally adjusted over the last 12 months, 2.9%. Well, if we look at where we were here at 7.7, and now you're at 2.9, they are doing their job in cutting inflation from the debacle that they created. The important thing about this is you don't see any signs either fundamentally or technically that this is telling us that we have an inflationary problem, despite everything that people are saying out there. It's just not accurate that this is getting significantly worse like before. And the reason for that is because we don't have the demand that you had in here. That demand was inflated and it was created by the Fed. We don't have that here. We're not competing with the Fed anymore for housing, for example. We were in here when they were out buying mortgages. So when we look at something like this that happened in 22, and I think this is really important to get, what really mattered? And this is something for people to remember. Well, here's all items less food and energy. And we all know that that is core CPI, right? So we can see regular CPI was dropping. The market didn't care. It strips out food and energy for whatever godforsaken reason, and it focuses on core. So what do we as investors want to watch going forward? We'd want to watch the core and make sure that the core continues to drop. So that is what we would monitor going forward. We would make sure that the core continues to drop or does drop going forward here. If we don't see the core dropping, then we know that we might have to start looking at charts like this and seeing if there's an issue. But right now, it's very hard to look at this and see any signs that we're going to see energy outperform and that we're really seeing inflation rear its ugly head. And we can see this in the bond market too. Now, if people are looking for something to pick at, and I think that you should always try to dispel where your thesis is. And again, I'm giving you my long-term thesis on how I see the world right now. And I'm doing it from 34,000 feet and looking at this going through months or years versus saying, hey, this is what's going to happen Monday, right? Which understand the context in which this is being presented. And so if I take a look at this area right in here, you'll see that this becomes that kind of demarcation line, doesn't it? And I think that's important. Here's September 2001, and we can see where we broke here, October 2007, and we can see that we're hiding in here. So is this something I need to concern myself with? Sure, when we peaked here, we could just see the rapid decline. And that rapid decline led to what? Well, the rapid decline that actually killed the market. So when yield implodes and they can't cut fast enough, yeah, that's definitely an issue. Is that really what's going on here? Not really. We're basically begging for rate cuts in here. And when he's doing it, he's saying, oh, it's preemptive, or this is why we're doing it. And then we just got this jobless data out on Thursday, which actually shows the labor market's not as bad as people thought it was. And the CPI data that just came out is not as bad as it is. So that actually puts us in a really good position going forward, looking at that macro data and saying that, there's a chance that they do cut again and again, but that is going to be way more orderly than what we are dealing with here. And if we really look at this as we did, going forward, it makes a bit of difference. And that takes us back to the S&P divided by the 10-year bond. Are we really seeing anything like this right now when we look at that chart? Meaning when we go back to the 2-year and then we click over to this, are we seeing any of this pattern of behavior that we saw before? And the answer to me is no, we're really not seeing anything like that. If anything, we're seeing the exact opposite. And I think that's a very important distinction. It doesn't mean that it can't change and that we shouldn't monitor it, but this is what we have to deal with right now. So let's just play the hand that we have. It's always good to take a step back and look at what's really going on. I do find great value in this because it does help us. In front of us is wants versus needs. And you can see XLY divided by XLP. And wants are, oh, I need those new Crocs because Sydney Sweeney has them, or those new jeans, or hey, I need soap to wash myself, right? Like there's a difference between a want and a need. And if we take a look back here from 04 going all the way through, when did we really break and roll? Well, that's in November 2007. You can see the actual crack. But for years, we battled this area in here before we had the big, great financial crisis. We battled that area. This only goes back to 99, and you can see it here as well. But I think this is super important because if we go through time and look at these areas, you can see it. It's not rocket science. It's always going to be during a correction too. You're going to see these during corrections. But in 18, 19, 20, you could even argue that this is telling you that, hey, they're buying their wants or they're buying their needs versus their wants, and I need to be aware of this. And then when it starts happening up here in 18, before we go into that little crash that happened right here, where they started to raise rates, you can even see it here, where all of a sudden they're not buying their wants as much, they're buying their needs. And I think that's super important to understand. So we have our little crash in here and the market falls apart. It's crazy how little that looks now, isn't it? And then just going through time and looking at this and saying, well, does this continue to mark things off? And the answer is yes, of course it does. And here you are in November again. And what are they selling? Well, they're selling their wants and they're buying, soap again, because that's what they need. It's so interesting to me too, because these pair trades are so profitable once you catch this kind of move, meaning that if you are, short the wants and buying the needs, and you just look at like how this trade played out over time from peak over, it's a 42% move in a bear market. It's kind of crazy when you think about it. But what do you have here? Do you have anything similar to what's going on there? No. What we have here when we had our pullback was before we all got liberated. What we had in here, very clear. Let's just clone this because I'm sick of that button not working. What do we have here? Well, we have our little, rise and fall and then crack in here in February. And that tells us what we have going on and what our problems are. What is this telling us? Is this telling us that we have anything like that going on right now? And the answer is no, it doesn't. It doesn't mean that you can't get it in the future for those that are looking for this, great bear market, but I would say, is this bear market in the room with us right now? When we start to see this stuff, it becomes pretty clear that they are buying their wants versus their needs. And I do think that to look at this and not see that is a huge mistake going forward. Now, if we look at the S&P divided by or in relation to needs, I think this is where it gets super interesting. If we go through time again, and again, this is only going to go back so far, but if we go through time again, you'll see these peaks and they're marking off exactly when that's pretty much it. And you can start seeing the rolling over. It's not really that hard to see if we go back to 2018 before we came in, or in November 2021, or even back here in January 2025. When we start to see these kinds of rotations, and we can go back again through time and see them over and over again, where the SPX related to the XLP, where XLP, the needs start outperforming. You see it in June, you see it in September. Like they're clearly giving you indications that this is an issue. And we only go back to 99, but you can see it here in March as well. But really the key here is, are you seeing anything like that that is telling you that you have a problem? No, a matter of fact, you're seeing left shoulder, head, right shoulder, neckline breakout. You would actually, if you were any kind of technical analyst, you would go here, measure that dip and go, okay, that's 15%. Wake me up when I'm up 15% this way, because everything has an equal and opposite reaction, right? You would know that that's just like technical analysis, 101. It's basically an enantiomer, right? You just flip this as a mirror image, and that kind of gives you an understanding of where that level is. So just FYI. But let's take a look at this, and then I want to get into some names because I think that this is super important. So this is the NASDAQ composite, and this is the Ichimoku cloud. These are all the parts of it. And there's just a couple key things that I want to go over that I think are really powerful about it. So we're always looking for this to tell us what is going to happen. Like I hate to say that it's a leading indicator because people always go, so there's no such thing. It does. It does a really good job of leading. Is it always right? No. And it turns very, very slowly. But when it does turn, you want to pay attention to it. And these cloud flips are always 26 out. So they're always 26 weeks out because in this case, because we're at a weekly chart. But if we were to, let's get rid of that. But if we were to go over here and just measure out 26 weeks and drop us to that 26 week mark, you'll see right in here that that's telling us, hey, this is pretty solid. So I use it more as a confirming level when the cloud flips, but there's these levels in here, which are conversion lines, baselines. This is your lagging indicator. I'm not going to get into all of it, but I'm just going to point out a couple key things that I think are super important. So if we take a look going forward, the most important thing for me is when this average right here that I have in orange, when that starts popping out. Now, I did a whole video on this, and you're welcome just to look it up. But if you're looking at this and you don't understand it, which if you're new to this, you're not going to get it, just understand that they're the names of the lines when I start speaking them, because I want to go through a couple charts with this, and that this is the cloud. Green is good, red is bad, duh. But the conversion line, baseline, lagging, leading, and then they're going to be the colors associated with it. So for our purposes, what we always want to focus on really is, making sure that the conversion line and the baseline are the way that they are, meaning you really want the conversion line above your baseline, and that's what you have here, and that's usually what you tend to have when we're looking at a weekly chart. The most important thing that I really want you to take away from it is some of the, in my opinion, some of the really interesting stuff is when these two cross and they get back on track, meaning when the, pardon my voice, when the conversion crosses the base. To me, that's a really big deal with the system. As long as this is your lagging, and as long as you're above, you're good. Again, I don't want to get into the whole thing. When it flips red, be aware. On a weekly chart, it might be, you might want to go to a daily, but I'm really looking for trend, and then I'm looking for patterns. And so what I'm going to do here is just drop this down, and then when we go through it, I'm going to leave a couple key things in, and for this particular time, and I'm just going to take some things out. So it becomes very clear what we're looking at. So what we're going to see here that we have in front of us is that we have the baseline, and that on top of the baseline, we have the cloud. And what we're going to show you, or what I would like to show you, are some similarities through time. And then you can make a decision if this is something that is significant or not. That's obviously up to you. So here is IXIC, which is the NASDAQ composite. And in front of us, we have the baseline. And in 3 cases over the past 5 years, we have the same setup that you have now. And it is the baseline coming out through the cloud on the NASDAQ composite over the past 5 years. You can see it right there, poking its little head out. Yay. And then we can go back here and see this in July 23 when it comes through the cloud, and it's poking its head out right here. And then we can go back to March, April, and then we have August 2000, and it's poking its head out right here. Is this anything that would tell us that we're going into any kind of bear market or anything like that? A matter of fact, not even close. So if you were to measure off from when we're above and breaking out of this to when we crack it and break through it, it's a pretty significant move. And I'll show you what I mean by that. So if you broke out of it here through that cloud, and then you close below it on the weekly, which you do up here, and we'll use that one, and you can use this one if you want. But what do you get out of that? Well, you got a 66% move. This is the first time it closes under it. And you'll see that that took time. It took over a year. You're popping out here on this one, and then you're stopping out here. All right, great. It's not perfect, right? But what does it do? It gives you another entry. And that entry that it gives you after it does it is right there. And then what does that wind up getting you? Okay, so then in this case, you made 25% before it happened, and it took time. Nothing is perfect, guys, and that's why I always point out the things that when they don't work, you have to know, like, nothing is 100%. But you have to understand what this did. It cracked it, and then it popped right back over. Cracked it, popped right back over. Cracked it, popped right back over. And now you're coming through it again. So we always just kind of want to look at history from a past performance perspective and then utilize that going forward. And this is telling us pretty clearly that we have the same setup that we just had in July of 23 and the same setup that you had in August 2020. Now, do you have the same drivers? No, I don't have Pal out here, just buying everything with chiclets. And I don't have the same situation here where we're imploding on CPI. But we have other drivers here that neither one of these had. And I think that's important too. Remember, we always look at the stool, the macro, the fundamental, and the technical. This is just one leg. But this is telling us that we are not seeing signs of anything that we need to concern ourselves with technically in regards to this. Here's the S&P weekly chart. And we can see when we flipped it here in September, we can see when we broke through it here as well. And this was July 23. And we can see when we flipped it back over here, April 25, and we can see we're coming through the cloud right now. And this is just that beginning stage. Again, it's past performance. It doesn't always mean that it's going to work, but it's certainly something that we want to pay attention to. And you're starting to do the same thing on the Dow right now. So if we start going through all of these, I think it's fairly interesting that this is exactly what's happened in the past. And when it's happened, this happened in March 24, which led to a nice run, and it's happening here again. We always just want to look at the past to get a sense of what's going forward. Let's look at some names and some themes that I'm seeing. There's some major trends that are going on out there. One thing that we would all agree upon, I would believe we would all agree on, is that we have instability right now. And we have instability with, we don't know what's coming next between tariff on, tariff off. It's definitely wearing on investors. And so what people will start doing is looking for investments where they don't have to deal with that, or that will hedge out that risk. And that leads to why, in my opinion, gold is going higher. And it's also leading to why XME is consistently just grinding. Every day is like a box of chocolates. We just don't know what we're going to get. With tariffs on, this one's 10%. And we had this happen to us again on Friday, where Thursday we're told these pharma companies that aren't making drugs here, all of a sudden, now they're going to get 100%. And then we saw names like GSK just absolutely plummet. And then, an hour later, just kidding. So when we see this stuff, that uncertainty, because we don't know what's going to stick, we don't know what's not going to stick, and that uncertainty definitely wears on us. When we see this, we tend to look for investments where we don't have to deal with this kind of nonsense, for lack of a better term. So when you look at something like XBI, and we just see from April on, people saying, I don't want to deal with this anymore. How do I get away from this? Well, if I took a look at XBI, and then I took something along the lines of, let's take the SOX, for example, and I overlay the SOX on this chart, you will note a significant difference. And by significant, here, let's do it this way, because then you'll really see it, I think. If we compare apples to apples, I think it gets cleaner. All right, so I made them both candlesticks. Now, you would look at this and say, oh, well, they're pretty much following the same pattern. Are they? Because I see a breakout here, and then I just see us grinding. Now, the other thing that I would say is the volatility, or ATR, between them. The average true range here, you're dropping something like 7%. And just so we're clear about this, semis are not always more volatile than biotech, far from it. But in this kind of environment, if we mark off the same areas, you'll find out that we're about 30% more volatile than biotech. That's not normal. If you go through history and you look at history, you won't see it that way. And I think that's very important for us to get. But it's hard to see with the chart the way it is right now. But it's not always that semis are more volatile than biotech. Far from it. Just ask any biotech investor and we'll just start laughing. But what you're seeing is, you know what? I don't have to deal with tariffs. If they're going to cut rates, the cash burn of these companies drops. Therefore, they have more chance of getting their drugs to fruition. So what we're seeing is this process and this pattern of, after these drugs get approved, they're seeing some significant buying. So I'll give you an example. This is MLYS. Now, this is one that we actually bought in the community. And when it came out and everything went great for it, it was $22. That was September 2nd. You have a double already. You're not worried about tariffs. Institutional investors are not worried about tariffs. They're not dealing with, this is a problem, that is a problem. It's just, we have this drug, and this drug is going to work or not work, and therefore the stock reacts favorably or not favorably to it. We're not coming in every day and being surprised. What's going to surprise you is when they have to go and raise capital. That's going to be your surprise. And then they're going to raise capital. It'll be oversubscribed because there's massive demand right now for these kinds of plays. This is working out very well for those investors that are doing this kind of trading. And there's two more themes I want to go over. But if you look at MLYS, does this look like it's over? If you go and take a look at something like Nectar and what happened there, and this was one that we actually bought on this move, and then I just held a runner. I tend to do that on some of these more explosive biotechs, make money, and then I know they're going to do secondaries, and I'll just hold runners on them and just compartmentalize the trade. But you're breaking out here. This is September 5th. You've gone from 37 to 58. No one's looking at these. No one's paying attention to it. And the reason for that is because we're all distracted by, what's going to happen next. INSM. This is one that I did, and I actually bought this on the news that they got approved. And then I did very well with the day trade, and I just left the runner on. I actually just got stopped out of it, but I think I got stopped at around 130. I think it broke in here, and that's where the stop. I finally got stopped out of it. But the important thing about this is these kinds of trades are working. So now you have this other one that everyone's looking at, and I think it's really important to get this. And I would be very clear. I don't know. I'm not a biotech head. Like, I'm not a biotech investor. There are people that are very good at this, that do exceptionally well in understanding the space. And this is a niche space. I'm not interested in catching the binary move. I want to be very clear about that. Whether you're here and you're saying, oh, it's definitely going to get approved or it's definitely not going to get approved, there's better people than that. Wall Street hires like the top doctors in the world and pays them an exorbitant amount of money to understand which ones are going to do this because the binary event is so great. What I would argue is implementing option strategies into those binary events. We should actually do a whole video on how to trade biotech going into a binary event because it's pretty complicated, but it's very lucrative because you do it through options. We should probably do that. That might be a good video. Just comment below if you think that would be worth watching. So if we take a look at this, what's happening? They got approved. They're going to do a secondary. We all know it, but we're going higher. This is why biotech's going to go higher because of that reason. If we take a look at the rest of the uncertainty, what else are you saying? And so when we look at this, I love that they call this UFO. But if we look at like UFO or we look at Jedi, I love these names. What are we seeing really here? Oh, that's not the one I want. Oh, maybe they changed it and made it this ETF because it used to be here. Maybe they moved that over into. I'm just going to leave this running, guys. I don't have time to edit it. I wonder if they're changing this ETF from what it was before. That's super interesting. That's September 26th. I'm going to mark that off. Now I got something to do today. I can look into this. And again, you're just going to have to deal with the raw and edit it. I'm not going to have time to cut it out. But with UFO here, and let's go back to this Jedi, which was this UCIT, which is a different format completely. These things keep going higher. The drones keep going higher. And I think that that's really important for us to get. Well, why? Why is this important? Because drone technology is not going away. None of this is going away. If you look at these names, they're only going to do better and better. And if you take one thing from this video, understand that the people that are actually doing fundamental research are killing it compared to those that are not. And I'm going to give you an example in a minute here of what we did in the room. But this KTOS, when the Secretary of Defense changed the language and how you would get a drone if you were in the Navy versus you don't have to file for an F-16, you have to file for a hand grenade to get a drone. Like it changed the complete language. That's why these names are moving the way that they are. That's why you're going to see these names move even higher because all of a sudden requisition of this product got a lot easier. That is not going to change. A matter of fact, some of the greatest moves that you're seeing on these things are even like these little guys like DPRO, HOVR. And so when you watch these videos, what we did today was we went from 34,000 feet and now we're getting into what? We're getting into the weeds and we're saying, okay, well, this is the activity. So if someone's long-term, they have to take that long-term picture. But you have to understand that in between that, some trees are going to grow faster and further. And that's where we're going with the video right now. So just understand the nuance with it. But when I ran these a couple of weeks ago and I was looking at this space is heating up. It's not getting weaker. It's actually getting stronger. And we all go through the whole semi thing and saying, let's look at semis and let's talk about NVIDIA for the 4,000th time. I got it. I don't think NVIDIA is going anywhere near down anytime soon, but it is what it is. Instead of just thinking about just how AI is going to affect this and what's going on out there, I actually think that one of the key things is not understanding the way that the global landscape is changing. Now, we've been buying this on and off since $30, and it got killed here when we got all that winning and liberation. But we've been playing with this for some time. There's no way that Europe, EU, AD, there's no way that Europe is not, the defense area is not going higher. Now, I actually think that Italy benefits the most from what's going on versus taking a look at something like Germany. I actually think that Italy is going to benefit the most from everything that's happening right now. And if you look at where some of these defense companies are, like Leonardo, they're actually they're in Italy. So I would pay attention to this. I don't think this is something that you really, you want to sleep on. The other flip side of this that people need to understand besides looking at things like that. We have the instability that's coming into Argentina right now, and that they needed a loan, and we're starting to see that roll over again. But a lot of people are looking at something like FXI, and they're watching China go higher. And I don't buy China for very long periods of time because I don't trust anything that comes out of there. And I'm sorry, I just don't. I've seen it too many times, and I've seen too many things come out where, here's a great example. This is Smart Digital, right? This is Smart Digital Group. Everybody see how it's just absolutely imploded and got hit? Well, here we go again. Well, what are they doing? Well, they're inflating it in here, and I'll show you what I mean by this. And I understand that Baba's not Smart Digital, but they're inflating it. Oh, we're going to be a Bitcoin treasury. We're going to be an Ethereum treasury. Actually, just kidding. And now you're left with a bag, right? Go look up Luckin Coffee if you don't understand what I'm talking about. It was supposed to be the Starbucks of China. And so this kind of stuff between the vacations that the CEOs take and things like that, I just have a hard time with it and a hard time believing it. And so that I have 8,000 other names to trade. I'm usually on the other side of these, taking the short. That's usually where I'm at, because eventually it'll come out, that there's an actual issue. It's like what we saw with DeepSeek. They were doing it with 3 chips, a paperclip and a hamster. And then it's like, oh, by the way, no, it's really from 4,000 GPUs that they got through Singapore. Oh, okay. So I tend to look at it with a grain of salt, but here's where you have to go with it. These are the A shares, and this is where we're going with it. These are the A shares, and the A shares are ripping, right? So that means that mainland's actually buying, because you have the A shares and the H shares. Cool. That means that people in China are doing exceptionally well in the stock market. Well, what do people do when they're in the stock market? Well, they buy things, right? They go out and they buy things. What do they buy? Well, they buy Ferraris, right? Whether or not you believe it, they do. And so Ferrari will stabilize. Well, what else do they buy? They buy European goods. Okay, so when you start looking at things like Louis Vuitton, and these are ideas that I'm looking at that I think are changing a little bit better than some of the other stuff, but they start buying Louis Vuitton bags, they start buying Hermes bags. So they start buying goods that are European goods, and they buy them in China. They're actually one of the biggest growth markets out there. And so that is an area that I'm also starting to take a look at. But what we should take from this is we don't just have to look at just what is AI doing, because the landscape is changing. And as we get that uncertainty, you're going to see gold go higher, and you're going to see, as I think you see gold go higher, but you're also going to have to understand all the inner workings of that and what's happening. And that instability creates opportunity, because people will start trying to divest from that uncertainty. They'll start craving a certain sense of certainty. People just do. And we can take advantage of that. We can also sit here and go through like the Teslas of the world and all of that. And we tend to do that in these videos. And I will say this, if you're long, you should be really happy the way it closed. Like, this was a really solid close and very surprising close, quite frankly. And if you really look at this, and I think it's worth mentioning, like, this is the all-time highest weekly close that you have on this. Like, you don't have a higher all-time weekly close on Tesla, and you should be paying attention to that. And in the midst of all of this, that's what we have right now. So that's it.